All right, we are back. So our next session deals specifically with financial firms such as asset managers, broker-dealers, hedge funds, and moderating this panel is a real seasoned pro on securities enforcement, Bill White. He's a partner at Allen & Overy. Bill has also he previously served in the SEC's enforcement division for 8 years, including as a branch chief and a senior trial counsel. Thanks for being here, Bill. Welcome.
Thanks. Thank you for having me.
Adam Aderton is co-chief of the SEC's Enforcement Division's Asset Management Unit. That is the specialized unit that's charged with investigating the very financial firms that we'll be discussing in this panel. So he is the right man to have on this panel. Adam, it's great to have you back with us at Securities Enforcement Forum. Welcome.
Thank you. Thanks for inviting me.
Our next panelist is Chris Conniff. He's a partner and co-leader of Ropes & Gray's Securities and Futures Enforcement Group. Prior to joining Ropes & Gray, Chris was an assistant U.S. attorney in the Southern District of New York, where he prevailed in cases including the famous prosecution of the Gambino organized crime family. Chris, welcome.
Thank you, Bruce.
Finally, we round out the panel with Terence Healy. Terence is a partner at Hughes, Hubbard. Prior to re-entering private practice, Terence was himself a senior assistant chief litigation counsel for the SEC Division of Enforcement. And he regularly represents financial institutions, hedge funds, private fund advisors. We're really pleased Terence can join us today. Welcome, Terence.
Thanks, Bruce.
Bill, let me turn it back over to you.
Thanks, Bruce. We've got a great panel for you today, so let's get right in and do what our main job is, which is to put Adam on the spot a little bit, maybe. And we're going to start, I think, with issues related to retail investors. And that's been a high priority for Chairman Clayton and therefore for the Enforcement Division. And I wanted to start with sort of retail conflicts of interest or potential retail conflicts of interest. Back in 2018, the division conducted its share class selection disclosure initiative, where the division, sort of recognizing that there was an industry-wide issue, offered some lenient sanctions for firms if they self-reported the issues and or the violations. And that program is concluded. The SEC brought a number of cases, and we've have enough time passed from that program that I think there's been some recent cases for firms that decided not to or didn't know about the initiative. So I guess just to start, Adam, I mean, how does the division view the program now, and related to that, how is the division dealing with firms that didn't partake of the program?
Yeah, thanks for the question. I think certainly for my unit, and I think for the division as a whole, we would look at this as a very successful program. This was a program that was launched when we had observed that we had brought a number of cases in this area, undisclosed conflicts related to 12b1 fees. And those cases have been taking us on average right around 2 years. The idea behind the initiative was to give sort of both a carrot and stick approach. The carrot is, in these cases, there was no penalty. We said at the outset we weren't going to recommend a penalty. We didn't, and we ended up returning something like $140 million to investors to retail investors primarily, who were clients of almost 100 investment advisors. And all of that happened in a period of most of it happened in about 18 months. All of it was completed in a little over 2 years. So, 100 advisors in 2 years versus 2 years per advisor at the rate we were going before. So on that side, the carrot side, we feel like it was pretty successful. On the stick side, we said when we announced the initiative that to the extent firms didn't to the extent we subsequently identified firms that were eligible to self-report but didn't, we would impose that we would likely recommend a penalty. Obviously, the commission's choice whether they want to impose a penalty. That reminds me, I should probably say everything I'm saying are only my own views and don't represent the views of the commission or any of the other commissioners or anyone else on the staff. So you're just hearing from me. For the IAs for the advisors that didn't self-report, we said we'll consider penalties, and those penalties may be higher than they were in cases before the initiative. And I think we followed through on that. We brought 11 cases against advisors that didn't self-report. Total relief there is around $25 million back to investors. So from our perspective, it's a very sort of coherent story. We found a problem, we found a way to expeditiously deal with the problem, and we followed through on what we said we were going to do if we had to devote additional resources afterwards.
Any downside from the division's perspective to the program? Is there anything that that you didn't like that came out of the program?
I mean, I don't know that I would say that there are particular downsides that I would point to. I don't know that this is the type of issue that, I'm not sure that you could do an initiative like this to deal with every issue that we find. This was one that was fairly narrow, was common, but wasn't sort of industry standard. So it was not a situation where we're going to go out with an initiative and everybody is doing something a particular way. We had seen a variety of disclosures, some firms getting it right, some firms getting it wrong. And it's something that was possible through data analysis. So for example, we said we brought cases against firms that didn't self-report. We can think about ways to look at data to identify those firms. So I don't think this is going to work for every situation, but for this particular situation, I think it was all around pretty effective.
I had some clients that were trying to decide whether to go in the program or not. They did, and there are really two questions that they were asking. One, are they going to be better off by reporting? And I think you just addressed that. I mean, I think my answer at the time was, we'll see. You should be, but there's only way we can find out is we see how it unfolds. But the second question that at least some clients asked was, okay, but in the program, there's a formula to some degree and there's no sort of individualized attention paid to specific facts. And so some firms may have had arguments that they changed their disclosure midway and maybe it wasn't perfect, but it was better. And therefore maybe there shouldn't have been discouragement to clients for certain periods. And I just my experience, maybe it's just me, my experience was that the division wasn't particularly open to those arguments as part of the program. Did you? Is that something that you saw, and how do you think firms should think about that going forward?
Yeah, I mean, I guess my sense sounds like it's a contrast to yours. I would expect that we would be to some extent open, and that it's at some point there is a curative disclosure, and it wouldn't be appropriate for us to recommend an action if the disclosure really is sufficient. And so I do think that there are sort of the gray areas in there where one of your clients may want to come in and say, we think this was adequate disclosure, and we would push back and say, no, and we're not, and we're taking kind of a hard line on that. And then part of that is to be able to have consistency across the number of firms that we were looking at with this particular initiative. Just in the interest of efficiency, we could be, when there was a clear curative disclosure or a change in practice, we could say, yes, we're going to cut it off then, but we probably, to get it done, can't go down every single disclosure question.
Yeah, I heard the same thing, Bill, from clients, which is, I applaud the staff for this type of initiative, because one of the key characteristics, from our standpoint on the defense side is clarity about the rules and clarity about the enforcement initiatives that the staff is undertaking. And, a program like this brings clarity. As you say, there's a period of time where you can kind of self-report. Everybody kind of can get in line in terms of understanding what the staff is expecting. And then after that point, you kind of err at your own apparel, because the staff has made very clear, what their position is. Sometimes I worry more about situations, particularly since my practice straddles, the civil and criminal enforcement space, not having that clarity and finding yourselves kind of being prosecuted initially, by a U.S. attorney's office, for instance, before the staff has really pronounced, their strategy, their approach to a particular rule. So I think clients appreciated the clarity initiative. I think Bill's right. There's always a reluctance, I think, on the client side to go in and self-report anything, because it's kind of like going to the doctor. You might feel relatively okay about what you're going in to complain about, but once you're on the exam table, who knows what else might be found. And that's something that really, I think, makes clients nervous, not because they think they've done anything wrong, but are we opening ourselves up to a broader investigation?
If I can follow up on that also, Bill, clarity is something obviously that all the clients want. And the share class initiative, Adam, got a lot of press for the SEC, and the SEC has done a lot to try to draw attention to it. If I can play devil's advocate just a bit, from talking to clients and advising them during this period of about 2 years, it was noted by some that there had been hundreds of OC exams where this issue was never identified. And when this initiative was brought, the Enforcement Division logged, as you said, violations against 100 advisors or so. And it was noted, like I think Bill mentioned, sometimes in the alternative space in particular, the investments are very complex, the structures are complex, there's really a lot of fact-driven issues. And that, with OC in particular, reviewing financial firms and having the vehicle of a deficiency letter, why wasn't that something that was identified earlier on in a way, rather than painting these firms as having committed enforcement violations, when for them it was just a matter of kind of a developing standard from the division? I won't say regulation by enforcement, but as you know, it's something on the defense side and in the industry that is said sometimes that, rightly or wrongly, that the enforcement division sometimes will come out with initiatives like this or sweep programs which seem to be creating a standard or adjusting a different standard than what had existed before.
Yeah, I think we hear that, and we're certainly sensitive to it. I think
I'm not the first person that said regulation by enforcement. I thought it came up.
No. You're, surprisingly, no. But what I would say is that here, we felt like this was a pretty clear line. We've been bringing cases in this space for a while. Cases about share class and disclosures related to share class go back at least to, it's in the broker context, but at least to a case from 2006, a commission opinion. I hear you that OC was into firms, and sometimes OC is looking at disclosures. But I think from our perspective, this was sort of a clear application of the Advisors Act, in that there was a form of revenue that advisors were receiving that was conflicted revenue, and they should be making a disclosure so that clients can understand and make an informed choice about that revenue. And I think from our perspective, that was fairly clear by the time we were bringing enforcement action in this space.
Adam, would the division consider a program like this again? It sounds like, from the division's perspective, that it went well, and I think it did all the things that you said. I mean, it did provide the clarity we talked about. People got this matter taken care of behind them. But is this something that the division would consider again? And can you give us any insight on in at least the types of cases or the criteria you think would be relevant?
So I hesitate to speak for whether the division would consider something like this again. I do think this one was successful. I think the criteria where it works has to be a situation like this, where sort of those factors that I described before exist. A fairly clear set of facts, sufficient notice in the market that this is something that we're concerned about, a big enough problem that we should be in the space bringing enforcement actions to correct it, but not so big a problem that it's something that literally everyone in the industry is doing, and that's something that could be better handled perhaps outside of the enforcement context. I also think it typically needs to be a situation where we have some ability to identify potential violators on our own, either through data analysis or the exam process or something else like that. So I heard Steph earlier today on one of these panels say no initiatives, in the works right now like this. But I think in the right set of circumstances in the future, it could happen. but I think you're going to have all of those circumstances to make it work.
Staying in with sort of retail investors, but shifting topics a little bit, the staff seems to have been focused on recently on revenue sharing on mutual funds and other programs like cash sweeps programs. Can you talk about what the division's views on that?
Yeah, and so this is a similar but slightly different problem, and I'll focus in particular on the cash sweep program. So a lot of cash sweep programs invest in either bank deposit sweep programs or money market funds that make differential payments to either duly registered IA BDs or to affiliated BDs. And what we have found there is sort of a similar problem where the conflict that exists among the choice of particular mutual funds we have found instances when it wasn't adequately disclosed. And so we are starting to bring some cases in that space. There are two recent cases. The first one in the space is a case called SCF, which was an advisor out in California. And then there's another one, Hancock Whitney, that we also recently brought, where this was one aspect of the case. And so it's another variety of the conflict. I think probably what's most meaningful from these cases is that to the extent an advisor is getting compensation and that compensation is conflicted, it's important to be really clear with your clients so that they understand the conflict and can give that informed consent that they have to give before you start receiving that compensation.
Terence, any thoughts on the revenue sharing cases or the cash sweep issues?
Yeah, it seems fees and expenses are sort of a perennial issue in the private fund space with asset managers. And I guess with all these things, Adam, it's just a question of disclosure. The whole federal securities laws in the U.S. are generally based on a disclosure principle. Largely, it's few things you cannot do if it's not adequately disclosed. Do you view these cash sweep issues falling within that same general area?
I think that's right. I think it's best to think about them much like the 12B1 fee issue. The one thing I would say is that we have also, these cases, not in the initiative, not in the Secure Class Selection Disclosure Initiative, but the cases after that have also included a best execution claim. And that best execution claim is really more of a duty of care than a duty of disclosure claim. And so it's not to say that any of this revenue is sort of off the table, but the disclosure that needs to be around it, if it is, to satisfy the duty of care obligation, often will come in the form of sort of scoping the relationship at the outset. So it may not be the kind of disclosure that you just do in sort of an annual ADV update. You may have to go back to clients or in some other way, make sure they're really aware of that you're getting this particular revenue because of the duty of care issue.
And related to revenue sharing, I mean, one of the cases that that the division has brought recently is the VALIC Financial Advisors. Actually, there's a couple of cases, but the one focused on revenue sharing, I thought was particularly interesting. Do you want to talk about that for a moment, and we can discuss?
Yeah. So it has the VALIC case has sort of multiple conflicts running through it. There's the 12B1 fee conflict, which is similar to the one that we were talking about in the initiative. There's a revenue sharing conflict where some funds pay more or any revenue sharing and other funds don't. One of the most interesting conflicts here is the ability to avoid a fee that VALIC otherwise would have been responsible for. And this comes about in the WRAP program. VALIC sponsored a WRAP program. VALIC was supposed to pick up the transaction fees for clients in the WRAP program, but then instead of purchasing funds that had, or share classes that had transaction fees or funds that had transaction fees, instead, VALIC purchased funds off of a no transaction fee platform, and as a result, did not have to pay the transaction fees that it would have otherwise had to pay as part of as the WRAP sponsor. Again, it's a conflict. It's an interesting conflict because unlike a 12B1 fee conflict or a revenue sharing conflict, it is not a conflict where VALIC is taking in revenue from a clearing broker. Instead, it's a conflict where they're avoiding payouts that they have to make. It's the other side of the ledger, but it's still a conflict that we would expect advisors to disclose. And it makes a lot of sense why we would expect that, I think, in the wrap fee context, because clients typically are paying more for a wrap and they're paying for those execution services, and arguably they're not getting the full value of that additional payment for the execution services if the advisor is sort of routinely selecting no transaction fee funds as opposed to transaction fee funds.
Yeah, I mean, to me, the reason I think the case is interesting, there's a couple of takeaways. One is that you've got to periodically examine the products and services and look at the revenue and expenses and adjust the disclosure as they change, because I think things do change and few things are static, and something that may have been okay in the past may not be now, either because there's a change or the attitude of the regulators has changed. And so firms have to have, I think, the ability to look at the expenses and fees and adjust disclosure accordingly. And to me, the second thing that comes out is VALIC did change their disclosure a little bit along the way, and that the other thing I think is noteworthy in this case is you've got to get that right when you make the change. And so close is good in horseshoes and hand grenades, but maybe not disclosure. And you just open yourself up if the process itself isn't really fulsome and you're not really disclosing what the actual fee or conflict is. And I think that's something that I've seen happen on a couple of occasions recently, where the clients have made a stab at changing the disclosure, but their change in the disclosure didn't really put anyone on notice as to what the fee was or what the revenue sharing arrangement was, and it's been a problem. Chris, I don't know.
That's really one of the challenges, though, right? I mean, from a client perspective, they're out looking at the changed circumstances. They're taking, as you say, a stab at providing proper notification, and you can still be questioned about it. And so it's a challenge for these asset managers to know exactly kind of what the expectation of disclosure is. You know, oftentimes, I'm sure we all have sat in boardrooms where, you know, the client is a little confused about, you know, why the disclosures they made are not sufficient because they feel they adequately lay out the facts without, you know, more detail than necessary. And when you're getting into a situation where you're being challenged in terms of the details of that disclosure, it can be a very difficult situation to kind of figure out.
Terence, any thoughts on VALIC or sort of the revenue sharing issues?
VALIC was an interesting set of cases. I think born the facts, like Adam said, it was complex and different things going on, but sort of paying a union to direct their union members to their advisor was an interesting little thing. And I guess, you know, like I was saying before, at least, you know, so much of the securities laws is a matter of disclosure, and I think it's sort of that falls within there.
But how much drives a case like that you had the union, the overlay of the union payments, which you know has a stink to it, you know, in terms of the more technical violations. Sometimes you wonder about that.
Yeah, and just for clarity, like there's sort of two VALIC orders came out at the same day, same press release. One is pretty technical. The other one is definitely this the fact pattern that Terence is talking about, where a union, this was a Florida teachers union, was a vehicle set up by the Florida teachers union, was paid by VALIC, and then was referring VALIC was the exclusive advisor to whom the union would refer teachers when they came for financial services. And you know, the case is is interesting. Like that's a kind of conflict for a vulnerable or potentially vulnerable group of investors, sort of squarely Main Street investors that this commission has been really focused on protecting. And I think that the outcome in that case is reflective of that. In particular, there's a really interesting undertaking that's part of that ballot case where there's a cap on advisory fees for current advisory clients for I think I don't know if it's time limited or if it's indefinite, but it's an interesting remedy. It's one we haven't seen a lot, but one that really, I think, provides a lot of relief to the retail investors who are trying to be protected in that case.
Thanks. We're going to move topics a little bit, but if folks watching and listening have questions for us, whether it's on the more retail topics, or we're going to move to some fund issues, go ahead and send the questions in. And even if they're on the retail side, we will still endeavor to circle back and talk about them. So with that, why don't we move a little bit to fund issues. Adam, there's been some cases recently. I wondered if you could speak on, and there's a series of cases where the conduct has been inconsistent with the disclosure, and so the Catalyst case and the Everest case sort of fit that from earlier this year, but there are a number of others too. So I wondered if you could talk about those.
Sure. And so Catalyst and Everest are interesting cases. In both cases, one is that Catalyst was a registered fund, Everest is a private fund. But in both cases, sort of the core problem is that the advisor went out and described the fund as having a really robust risk management and investor risk management procedures that would mitigate against losses, and in the case of Everest, also mitigate against concentration in particular investments. And then the funds weren't managed consistent with those disclosures. So it's a pretty straightforward theory for us when you go out and say we're going to have, in the case of Catalyst, a procedure that's going to cap loss, stop losses at 8%, and then the fund ends up losing, I think it's well over 8%. I know it's a significant portion of the value over a period of a couple of months. Everest, there were representations about the ability of risk management to sort of step in and override to limit risk, and that wasn't true, or at least our order finds that wasn't true. And so in both of those cases, what I think is maybe most interesting, and what I think is interesting in the current sort of COVID environment, is they underscore the need to manage the product consistent with the disclosures. In the case of both Catalyst and Everest, it wasn't, in the case of Catalyst, it wasn't sort of a market-wide problem. It was a particular problem that they were having. In the case of Everest, it was a specific investment that blew up. But I think what calls more attention to these facts and these concerns now are things related to the pandemic. This is an issue that we are concerned about sort of going forward. A fund that was set up in a particular way to pursue a particular investment style, may drift away from that. And we saw that in the global financial crisis. We see it from time to time on these sort of acute specific crises, like what happened in Everest. And so this is a concern that we're really focused on now, making sure that funds are managed consistent with their disclosures. And if the strategy is going to change, making sure that is clearly communicated to the investors in the fund, and to the extent the fund has a board, to the board of that fund.
And Terence, any thoughts or takeaways from this area?
Yeah, no, it is interesting, and I didn't work on the either Everest or Catalyst cases, so I read those releases when they came out, Adam, but I don't know anything beyond what was in the press release. And sometimes on the defense side, there can be a feeling that cases may be a little more nuanced than is reflected in when the cases are filed. But my question is more general. In the private fund space in particular, it's very common in the fund formation documents to find a fund that describes an investment strategy or practices it will follow, then also has language saying, notwithstanding above, the manager will pursue whatever strategy it believes will advance the return on the fund. It's more of a philosophical question, I guess, but where a fund has language like that, which really gives the manager discretion to not even follow the general strategy or practices outlined in the document. And this is disclosed to investors. So on the front end, they can make the decision to either invest or not invest, and with giving this much authority to the manager. What is, from the perspective of the asset management unit, how do you evaluate those kind of, I won't call it blank check, but those kind of, catch-all provisions that a fund may have, where investors are told the manager may divert from, a particular investment strategy or concentration strategy into other areas? How do you evaluate whether those kind of, whether investors have been told some misstatements when the manager does end up doing something different than what the fund was generally described as doing?
Yeah, so I think in those cases, we'll take a very, we'll start, hopefully, everyone is starting with the fund governing documents and the offering documents that were provided to investors. And we will start from the position of, if a reasonable investor read this, would they have been materially misled on how this fund was going to operate? And so really it comes down to, if it's, if there's a warning label on a private fund that says, this is what we think we're going to do, but we're not sure, and we're going to follow, market opportunities. If that's the fact pattern, then that's not especially appealing to me as an enforcement matter. And it really comes down to the sort of the facts of what investors would have reasonably understood reading those disclosures.
And Chris, I mean, from the client side advice, facts do change though over time, and whether it's risk management protocols that you may have had in place at one time, sometimes they shift and they change. This is difficult for clients to get a handle on. I think. Do you agree with that, Chris?
I do agree, and I think that the challenge around some of these cases, and just I'm talking kind of generically now since we were involved in one of them, but is the foreseeability of a particular circumstance. I mean, it's okay, and I think expected to have significant risk management functions in place at the firm, and for those to operate, as Adam said, consistent with the offering documents and the marketing of that fund. However, there are circumstances, you mentioned the crash, and obviously we're going through the pandemic right now where market circumstances can exist that were just totally unexpected, black swan type event. And I think there's greater tension between the risk management function and the expectations versus normal market operating circumstances. And I think that's, to me, I would expect part of the analysis that the staff would bring to any investigation where the issue is whether the risk management function worked as advertised, so to speak. Because if you can't anticipate, if no one could anticipate what was coming, it's hard to advertise how the firm would react to it.
Yeah, from my perspective, I think that's a fair point, and I think we're when we think about these cases to be careful to recognize that. For example, just in the Everest case, there was specific language about concentration, and here we had a concentrated bet that was sufficient in one particular portion of the market to sort of implode the whole fund. And so for that case, I feel like that one is not one that's necessarily close to the line, but I certainly take your point that there are cases that are close to the line, and there, I think we should probably use good judgment in whether we should be second guessing the way somebody manages their risk.
Yeah, and one of the things that surprised me in this area is the number of firms that don't actually have a procedure to regularly do sort of a full assessment on their disclosure for their funds. Some do, but a surprising number don't. And I think that's got to be something that's a component of the compliance program, which is, okay, we're going to look at the disclosures that are out there. Has anything changed in sort of key elements, obviously focus, but on fees, on revenue sharing, and sort of the topics we've been talking about. And I think that can be done in-house, but I think a lot of funds it would make sense to at least periodically sort of subject their disclosure to sort of an outside, whether it's a firm or someone else, to come in and look at and think about it sort of outside the box, because that's where I've seen some firms who didn't really understand that they had an issue. And it's been sort of that outside focus on it and questions raised, and they say, oh, gee, I didn't fully appreciate this, and have fixed it and been ahead of the SEC or anyone else looking at it. And so I think that can be pretty important as well.
Yeah, I think, Bill, to your point, and the point we were talking about earlier around clarity, I would expect, Adam, I don't know what you think about this, but I would expect the staff to have an expectation that after any kind of event, whether it be a market crash or the like, that there would be a reassessment from a risk management standpoint of how the fund performed and the risks that are inherent from a particular set of circumstances, and build that into their risk management portfolio going forward.
Yeah, I don't have the ability to prescriptively say that that's something someone should do, but it seems like a good idea to me, not just from the regulatory risk perspective, but from the business perspective. If you've been through something like this and survived it, it's worth taking a look. It's worth taking a look at why and updating to make sure that you can robustly survive the next one.
Possibly a related area is with ESG funds, or funds that have an ESG strategy. There has been a ton of press on funds that are focused on that strategy. There has been a fair amount of comment from multiple commissioners at the commission on different aspects of ESG investing in ESG funds. How are you approaching, from the SEC enforcement side, sort of approaching this sort of explosion of ESG focused funds and the disclosure issues that are related to them? Yeah,
so right now it's been an incredible boom, and something to witness from where I'm sitting. I know that this is something that OC is examining for and looking at carefully. I think they've been pretty clear that this is something that they're interested in. It's also clear that a number of commissioners have sort of substantive concerns about different aspects of ESG procedures. From the enforcement perspective, as I think about this, I think it's another area. I do think it's related. It's sort of strategies consistent with disclosures. As I think about this, and as I think about what the most likely enforcement case in this area is going, or the most likely enforcement cases in this area, what are they going to look like? The hypothetical that I would see is someone who, has engaged in some kind of greenwashing, or has said that they're going to do some sort of ESG screening and other ESG metrics, and then just doesn't follow through with those. I think that's the kind of case that that is likely to come out of enforcement first, and I think that sort of fits squarely within what we've done before. ESG is sort of a new area, but it's the same idea as, following through with your risk management disclosures, or following through with your investment objective disclosures, or anything else. So that's my expectation.
I do think that that there's going to be a number of firms, a number of funds that have this focus. They're going to have issues, and they're going to range from intentional to not particularly intentional, where they sort of fall into a problem, depending on how they define what ESG means, which I'm not entirely sure of on any given day. It seems to maybe change. But it does seem like to me that you're going to have you've got a sort of a deluge of funds with this focus, this strategy. I think you're going to end up with a lot of firms that have particular issues, and not that I'm putting a plug in for this, but I think this could be down the line very well could be an area that would sort of qualify for a similar program to the share class disclosure program, because I think you're going to be overwhelmed with these cases at some point, or at least when I say case, at least these situations. Terence, any other thoughts on ESG?
It's a very interesting area, and it's really the probably most rapidly developing area in asset management, I would think, Adam. And everyone on this panel and virtually everyone in the audience watching this is advising clients on issues related to ESG. And there's so many developing issues with ERISA, Department of Labor, and Europeans creating their own standards. But one thing, and in terms of clients, we always talk about enforcement cases, does something fit in a box? But really, so much of what 90% of what we do, if not more, is clients want to do it right. And a lot of people with good intentions are creating new funds. They're using the buzzwords of impact investing or ESG, and the investor interest, as you know, including from pension funds, is very high. So in terms of the fundraising, it's very easy. But then here comes this question, Adam, you mentioned greenwashing. How do you determine whether something is a truly impact-related investment vehicle or is an ESG investment vehicle? And traditionally you have investment strategy, something long short or tax-exempt bonds or European small cap equities, and you can measure whether the investment is that. In here, there's really no standard. These are some like vendors and the big four trying to develop some kind of standards to say whether something is or is not ESG. And I don't know, Adam, if you have any thoughts on that. We'll give you sort of a break. We've been pointing everything at you. But one challenge is if the exam staff comes in, if someone challenges a fund as what they're actually investing in are not ESG related products, there's really no standard to evaluate that. I mean, just one example, we have a client who is mines graphite, and now they're a very hot investment because graphite, as the chairman always says to me, every time you see a Tesla, it's 200 pounds of graphite going down the highway. So is investing in a mining company that mines graphite, is that ESG? The instinctive reaction of most people is anything involving mining is not environmentally friendly. But it's just a challenge, Adam, and you guys will have opportunity to help develop this area, I'm sure.
Adam, you can run out the clock on this one, I think.
Yeah, I will quickly say that. Again, that's why I think that I think to the extent we see cases in this area or see problems in this area, I think it's less likely to be sort of a substantive judgment of, well, that's ESG and that isn't. I think it's gray enough from my perspective that, advisors can tell people what they're going to invest in. And then the question from our end will be, well, and how they're going to invest in those products. And then the question from our end will in particular be, well, did you do the how? Did you follow through on how you were going to identify your investment targets?
I think we've got Bruce here. Bruce, I think we are just out of time, but I want to thank the panel and thank everyone for listening. Bruce?
And Bill, thank you for doing a terrific job moderating the panel. It's great. It's a great panel, great topic, and really appreciate everybody's insights. So our final panel on whistleblowers is coming up in 5 minutes at 4:40 p.m. It is a great panel. It's a rock star panel. We'll see you in a few minutes. Be right back.
Great. Thanks very much.
Thanks.
Thank you.